Welcome to episode 5 of the Chamber Music Mindset. I am Anna Rathman, your host and the founder and CEO of Granadilla Advisory. All right, we have a lot of information today for me to share with you. I'm going to talk about the market performance and certain patterns, earnings, market information. And then I want to talk about Intel and what's happening with Intel and what's happening around Intel. I want to talk about tariffs and the impact of tariffs that may or may not be showing up in certain inflation figures. I gave you a little clue last week at the very end. And then some questions about the Bureau of Labor statistics and the Fed independence that people have been asking me about. I just want to clarify a few things and then talk about things that are coming up this week. Okay. So let's start with the market performance. But before I get started, I do need to remind you that what you hear today in this video is for information purposes only, and it is not investment advice. I am also the Chief Compliance Officer of Granadilla Advisory, so I have to make sure that that gets said. Okay. Market performance. We had a positive week for the S&P 500 and also for small caps, Russell 2000. Now, there was some volatility. We did hit an all-time high for S&P 500 as well as NASDAQ last Tuesday after the CPI report came out. We'll talk about why that happened a little bit later. But, when the markets hit all-time highs and it keeps going up, when the environment is uncertain, it does tend to make investors nervous, especially when the valuations are stretched. And we'll talk about that in a second. Tariffs have just begun to make its way through the economy and through earnings. And we did hear a lot about that in terms of tariff impact and how much it's impacting margins by the companies that have reported, the companies in the S&P 500. So when we're hitting all-time highs, it does make people wonder, well, why is it hitting all-time highs? Is this froth or is this just momentum? What is it? Well, it is August, and I do think that we have to be a little bit careful about what the market is doing in the month of August because the volume tends to be low. A lot of people are on vacation still. School hasn't started. Sometimes the market becomes more sober after Labor Day. And I'm not saying that if there's going to be a correction or anything like that. Nobody knows. No one has a crystal ball. But August tends to be a little bit of a strange month when it comes to market performance. So take everything with a grain of salt, right? Especially because we have some uncertainty. We are living in a time of uncertainty. And I'm sure when you look around, if you're curious about the markets, you do hear other people talk about some of the froth that's in the markets. So what does that froth look like? Let's talk about valuations. Price to earnings is sort of the most popular way of looking at public market and public company valuations. So what are we looking at here? Let me take a few steps back and talk about two different PE ratios, price to earnings ratios. One is trailing. So price at the top is, in terms of ratio, is the actual price today. And then the denominator, earnings, in trailing terms, is the last 12 months of earnings. So when we talk about PE ratio, actual, we're talking about the stuff, calculation with the stuff we already know. Price is known, 12-month trailing profits, earnings, is also known. That's backward looking, right? But we do have something called a price to earnings in terms of forward earnings. This is estimate of what we think, what the analyst community thinks S&P 500 companies will be able to achieve in terms of earnings. So this is an estimate. So the price up top is known, it's today's price, and then the denominator for forward earnings is an estimate. So we look at both of them. Right now, as of close of last Friday, the valuation PE ratio forward earnings is 22.8. This is by calculation through LSEG. 22.8, that's almost 23 multiple. That's really high. For your information, long-term average, we're talking several decades, is in the mid-teens. So the market is definitely high compared to the earnings that is supporting it underneath. Now, in terms of trailing earnings, this is the known. PE ratio is about 24.6x. So the PE ratio looking backwards is higher than looking forward. This basically means that given keeping the price the same, there's a lot of expectations for high earnings that will bring the valuation down from last 12 months when we're going forward 12 months. This is a bit optimistic, but it's almost always like that. The market is full of a lot of optimists, and we do expect companies to grow. The big test for the markets will be, can the companies grow at that pace, given that there are a lot of uncertainties about tariffs and a lot of uncertainties about supply chains? So this is going to be, that's the uncertainty. It's not that the companies won't grow. It's not that, something catastrophic is going to happen. The uncertainty is that we don't know if we're going to be meeting those expectations. So that's the nervousness that people have around the uncertain environment that we are in right now with regards to investing. So I just wanted to make sure that that gets communicated in terms of why people say that the markets are frothy, why people say the valuations are high, that there's a lot of optimism priced into the market. Now, in terms of optimism priced into the market, it's not just optimism, it seems to be perfection. And we did see that. So it didn't matter in terms of earnings performance if the companies actually outperformed or underperformed or met expectations. All of those companies, the average was in terms of 2-day price performance in the negative side. So the markets were definitely priced for perfection, and unless you absolutely beat it out of the park, like Microsoft a few weeks ago, your price action on average was going to be negative. It was disappointing for the markets no matter what you did. Now we have about 92% of the S&P 500 companies having reported already, so we're sort of winding down here. We have 80% of those companies that have reported beating on earnings and revenue. We do expect them to beat because that is sort of the game we play in the public markets, right? We set the expectations at a reasonable place and you work really hard to beat it. This week coming up, we have some companies that are reporting that are that will give us a clue about the American consumer. And we're talking about the retailers like Walmart and Target, etc. So we'll be looking forward to that, and we'll certainly talk about that next week. Okay, now let's move on to Intel. So if you watched our last week's episode, I talked about how the US government has struck a deal with NVIDIA and AMD to take about 15% of the revenue from selling chips to China. Okay, I wasn't in favor of it. I basically said that I don't like it when government takes an interventionist approach in the private sector. And then some more things happened this past week. Thursday, I believe it was Thursday, we learned that there is some plans for the U.S. government to take a stake in Intel. Now, Intel price actually it rallied, its stock rallied. And that's because Intel has been in trouble for a while now. And Intel has been restructuring, a massive restructuring effort to laying off people, as well as a lot of turnover in leadership as well. And the plans to build a hub in Ohio for chips, that has also been delayed. There's been a lot of trouble there until 2030, all of those things, right? So when there's news that somebody's coming in sort of to the rescue, it seems like, it sounds like good news, because as far as Intel is concerned, it may be help that's coming in the way that nobody expected. This doesn't mean that the markets actually appreciate government coming in and taking a stake in the company. It was very Intel specific. This is, in my opinion, not a good news. When the government comes in and takes a stake, the question is, if it owns a part of the company, what does that mean? Who has a voice? Does it have high market share? Does it have a seat on the board? Will it have influence on who they hire or not? This is a very tricky, very, very gray area. Now, back in the late 90s, when I was in college, our beloved Ec 10 professor. Actually, no, it wasn't Ec 10. It was American Economic Policy professor Martin Feldstein, who was the senior advisor to President Reagan back in the 80s. Because we're talking about American economic policy, and that was what the class was about. We talked about privatizing Social Security. That was actually one of the topics that we discussed and studied. And one of the problems with privatizing Social Security would be government would be a shareholder. That the Social Security Trust would be a shareholder. The question is then who has influence on the markets? And the US government and that trust is huge, which means will the government own the majority of these companies? That would be a very problematic thing. And it actually, there's sort of a church and state thing here, except it's more like private industry and state versus state. There needs to be a curtain. And so that the private industries can thrive and can make decisions based on their own, shareholder interest and best interest of the business. The question is what happens when government gets involved and becomes a major shareholder. And so it was not a good idea. Now, if they had invested in the S&P 500, they would have done very, very well. But that's not the point. The point is that we need to actually respect the integrity of the private markets. And this sort of, in my mind, encroaches upon this notion of the government going into the private industries. Now, the government is doing this in industries that it feels that there's some kind of a national security issue. So this is not the first time, even though it's sort of made a big splash, because tech right now is making a big splash. U.S. Steel, I don't know if you guys remember this, but last year, Nippon Steel was trying to buy U.S. Steel because U.S. Steel is in financial trouble, right? But there was a lot of pushback from the Biden administration, and it kept getting derailed. It derailed and derailed. And a huge part of it is steel is a very important thing in all of our manufacturing. And I don't think the administration wanted a foreign company to own it. But the problem is that U.S. Steel was in trouble. So the question is, who's going to be the buyer? Because they needed some kind of a rescue. What happened with the Trump administration, with the new administration, is that this was approved with the condition that the United States government would have something called a golden share. And that golden share is not actually having an equity stake, like what is being discussed with Intel, but giving the government a voice in very, very strategic decisions about the company, about the things that actually impact the U.S. economy, as well as Defense Department. Steel is used in a lot of things, right? Sort of like tech companies. So I don't really know why this is not used, because this is used in other countries as well. It's not something that the United States invented. I don't know why we're trying to take an equity stake in Intel. The other thing that happened is MP Materials Corp. And this is something I learned recently as well. It's a rare earth minerals producer. So now there is still this theme of tech, of things that we need from China. Remember I said last week that we need rare earth minerals from China. This is a U.S. producer, and actually the Defense Department took a very large stake in preferred equity position in that company. So apparently now the Pentagon is the largest shareholder at 15% of the company. All of this sort of muddles the ground that on the playground here. The sandbox is becoming very strange and muddied. It's not pure sand anymore. So this is becoming an interesting thing for me to watch. Just so you know, I'm not in favor of this. Right? The U.S. government, I know we need money, but this is not the way to do it. And I know we want to be able to control, especially with national security and this AI race that we have, and to procure the things that we need. But government taking a stake in private companies, it's just not the right way, in my opinion. So that is that on company news. It is not necessarily positive news, but certainly Intel stock rallied. We'll see what happens this week. Okay, let's take a look at inflation numbers from last week and how tariffs may or may not have been a part of it. last week, at the end of the video, I talked about the things to come, and one of them was CPI and the other was PPI. CPI is Consumer Price Index. It's the price impact that we, as you and me as consumers, experience. Normally, markets pay a lot of attention to this, but there was also Producer Price Index, or PPI. Normally, the markets don't pay as much attention to this, but last week I mentioned that this is a number that was maybe very, very interesting, because what PPI gives us is how prices are moving at different nodes of the production line or the supply chain. And that would be really interesting to see who is absorbing the tariff prices or tariff increases. Who is absorbing this tax? Because last month we didn't see it in the CPI. And frankly, this time around, we also didn't really see the impact on CPI. So let me get into the numbers here. Core month over month CPI went up from 0.3 from 0.2 to 0.3%. So it ticked up a little bit. Remember, core is excluding energy and food prices. We're trying to get something that is more consistent, because there's a lot of noise in those energy prices, especially. Core year over year was 3.1%. It went up from 2.9%. Now, I thought that was something to pay attention to, especially because psychologically, we went from a 2 handle to a 3 handle. But apparently the markets didn't think it was a huge surprise. In fact, the markets actually hit, that's the day that the S&P 500 and NASDAQ hit all-time highs. And treasury yields fell because traders are thinking, oh, well, this isn't a huge surprise, and therefore the Fed is probably going to cut rates because the labor market, it'll pay attention to the labor market because it's so weak. Headline CPI month over month went from 0.3 to 0.2. A lot of that was due to the energy prices, and this is why we like to look at the core. And headline year over year didn't change much at all. Now, in terms of tariffs, where did we see it? Random places. There wasn't anything to point to, hey, this is what the tariffs are doing. So furniture and bedding, this stuff gets imported a lot. That went up a second month in a row. But appliances, including major appliances, fell. Okay, nothing, no changes, not much in apparel. All of these things are imported, much of it. Tomatoes apparently went skyrocketing high. If you grow tomatoes here in the United States, it's actually been a really good summer for tomatoes. So we're talking about imported tomatoes here. And I hear that we do import a lot of tomatoes from Mexico. So random things going up, but there's nothing, trend-wise inside of CPI that we should be worried about. This is probably why the markets were happy, because they didn't see too much of a tariff impact inside of the Consumer Price Index. But then 2 days later, we got the PPI. And as I suspected, it was very, very interesting. So let me start with the numbers here. PPI, year over year, this is headline, went up from 2.3% revised to 2.4. So let's just say 2.4% to 3.3%. So not only are we at a 3 handle, we went up almost an entire percentage point. What we were expecting was at 2.5%. So 3.3% headline, huge. On a month over month basis, prior month, we had 0% change month over month. That shot up to 0.9%. So almost a whole percent month over month. We were expecting 0.2. This is a huge miss to the wrong side. Let's go to core PPI. Last month, we were at 2.6 year over year, came in at 3.7. So more than 1% here. We were expecting 2.9. Surprise to the wrong side. On a on a month over month basis, core PPI, which is minus food and energy, again, we had no change. On a month over month basis last month, we were at 0.9% month over month from last month to this. We were expecting 0.2%. This is a huge surprise. And at this, the markets fell because, again, huge. And what did we see? Going through the different parts of the supply chain, we saw that the earlier in the supply chain, the prices, the price hikes are felt the most. So it seems that the people who are on the earlier side of the supply chain importing, if you're in the earlier side of the supply chain here in the United States and you're importing more like raw materials, right? Goods from the outside world and making it here, that's who is assuming a lot of the tariffs here and then being passed down. So what you see is the price hikes are higher earlier on in the supply chain, and it's still high, definitely, but going down the supply chain toward the consumers, it gets lower and lower. Okay, and when you round all of that up, it is at 3.7% year over year core PPI. Okay, what does this mean? It means that so far, at least last month, the businesses have absorbed whatever tariff impact there was in prices, in their production, and didn't pass as much down to the consumers because the CPI in the same month, we didn't see that much, as I talked about earlier. Now, not all tariffs have been put into place, right? And in the coming months, businesses can't continue to absorb all of this. This is going to have an impact on the margins. There's no free lunch here. Either you and I as consumers are going to have to absorb it, or the businesses will have to absorb it and the margins will be lower. Okay, so somebody is paying taxes, and guess what? It is not the country where these goods are originating from. Okay, it's the American businesses and Americans who are actually paying for this. So this is not necessarily good news, and coming in the coming months, it is not hard to think that the businesses will feel the need to pass down these cost increases to the consumers. So we may be seeing this down the road in the CPI in the remaining months in 2025 and maybe into 2026. I do think that tariffs are sort of a temporary price hike, but if this actually stays afloat for a long time, it can actually seep into the services area where the tariff price increases from tariffs on goods can actually be contagious and go into the services side. We don't know if that's going to happen. This is only wait and see type of a thing, but certainly it was not good news, and there was a very good reason why the markets fell last week. Now, people have been asking me about two topics, especially because of a lot of noise out there right now, about Fed independence and the BLS, the new leader there, Mr. Antony or Anthony. I've heard it pronounced both ways. Now, Fed independence I talked about last week, so I'll just talk about BLS. BLS has thousands and thousands of statisticians, people who have been there a long time, people who know the process of gathering information and actually running them through the statistical models that they have. They know them inside out, and they have a process that they have been running. And this consistency and integrity is very important to everybody, not only our economy, but also to the financial markets, because we rely on the integrity of those numbers to understand what is actually happening. Those numbers are important, especially labor data, because that has the power to move the markets. So when people are questioning the integrity of these things, it's not healthy for the financial markets. But I think there's a worry about potentially politically motivated, maybe not potentially, hiring and firing of the leader of BLS. And I do have something to say about that, if anything, because it has an impact in the financial markets. The reason why I mentioned the thousands and thousands of statisticians at BLS is because they are there to defend the process. And if something is not going well in that, they will speak up, because the data integrity is so important. So just because you have the changing of the guards at the leadership level, it doesn't mean that everything is going to be skewed or lose integrity or skewed one way or another right away. That doesn't happen. These are figureheads. Now, the labor market data, it does need improvement in terms of gathering of the data, as well as survey response rates. The models probably need to be updated because the labor market has changed so much in the last 5 years. This has been a known thing for the last several years. Those of us who look at these numbers have been talking about them for years, since the pandemic began. And we saw the discrepancy and the amount of revisions, or the magnitude, I should say. The magnitude of the revisions were getting higher and higher. That basically tells you the initial number isn't as reliable. So this has been going on for a while. So any kind of improvement to better reflect the labor market is definitely warranted and welcomed by the community here, the financial markets community. Unfortunately, there seems to be a perception of politics that has been embedded in this, but I would not worry about that at this time, because improvement needs to happen. And there are a lot of people who are going to be watching this. I'm going to be watching this. There are so many people who have a lot of stake in the integrity of the data who will be watching it like a hawk. And these are government numbers and processes, so we have transparency into them. So I wouldn't worry about it at this time. And if there is something to worry about, many people will speak out, and there'll be, and you'll certainly hear it from me. But I think there's a lot more noise here than is warranted at this time. So I do want to provide a little bit of comfort by talking about this, because more than one, in fact, a handful of people have asked me. I gave a talk at a conference over the weekend, and it also came up as one of the questions. So I decided that is something that I need to address, at least in this video. Now, coming up this week, there's a lot of housing data. We have from the building phase of homes to existing home sales. All of this is coming up, as well as the index to how the housing market is doing. So maybe next week, what we need to do is actually talk about the state of the housing market. So that's what I'll be focusing on this week to provide to you in terms of my opinion and what I'm seeing and the data that's out there next Monday. As well as we have the S&P Global PMI. Remember, we talked about the ISM Purchasing Managers Index, the diffusion index with 50 at the center as neutral. Now there's an S&P version of that's coming out. So we'll see what that one says and how the markets may or may not move based on it. So that's coming up this coming week. And that's it for this week in terms of our video. Thanks for tuning in, and we'll see you next week.